Good afternoon, everyone, and welcome to our session, 2026 Private Equity's Next Frontier. Global economy today is full of conflicting signals. In the United States, the labor market has been broadly resilient, though the latest data shows some softening and rising concerns about slowdown. At the same time, equity markets are hitting record highs, reflecting investor optimism driven by AI, productivity gains, and the prospects of lower rates. Inflation, policy uncertainty, and geopolitical tensions remain in the background. And what we see is a widening gap between financial markets and the real economy. My name is YS Kim. I represent Permira here in Korea. It's a great privilege to moderate today's conversation. For those of you less familiar with us, Permira is a global investment firm founded in 1985, managing around 80 billion euros in private equity and credit. We focus on 5 key sectors: technology, consumer, healthcare, services, and climate. We partner with fundamentally resilient businesses around the world. We have over 500 professionals in 17 cities committed to long-term and structural growth at scale. Today, we are fortunate to be joined by Kurt Bjorklund, the executive chairman of Permira, one of the most respected leaders in the private equity industry. Together, we'll explore how to navigate these conflicting signals, where the next opportunities and risks may lie, how structural shifts such as AI are reshaping investment practice, and what it takes to sustain sound judgment in complex times. Now, let's get started. The market right now is sending very mixed signals. In the US, the labor market has been resilient overall, but the most recent data points some softening and have concerns about the slowdown, while at the same time, equity markets are record high. So let me begin with this. In such a contradictory environment, how does Permira interpret what's really going on? And when policy, fundamentals, and valuations don't align, what ultimately guides your investment decision?
Yeah, so I would first of all caution as a private equity investor against getting hijacked by noise of the day. We raised capital, we invested over 3-4 years, and we then own the companies for 5, 6, 7, 8 years, and then we sell them. And whatever the noise of the day on the US labor market or the European consumer price inflation or whatever it might be says today has very little bearing of what the world will feel like for the next 5 years, for the next 8 years, as we'll be investing our capital and governing the companies that we're backing. And I will answer your question why yes, but first of all, for us, it's vastly more important to identify the right long-term growth themes where we can see companies that structurally will benefit from long-term trends and where we can back or create a number one market leader that will benefit and drive that trend. That's the most important thing. And then the sort of macro noise will come and go, and it'll feel intensely uncomfortable at times, and it'll feel a bit too easy at other times. But we cannot be swayed in our core beliefs and our core strategy based on what the macro of the day says. Now, having said all that, I think we are coming off a synthetic and long positive macro cycle. So the cycle that otherwise might have felt different, it was put on steroids over the COVID period through a expansive and reckless fiscal policy in many nations. It was then sort of put on hold with this inflation bulge that went through the world. And the economy, I think 2-3 years ago, most observers would have believed that it was going to stop and pause and slow down. But that hasn't really been the case, because we've seen a very strong continued consumer. We've seen, of course, this incredible cycle of AI investing and productivity gains that's now sweeping through the economy. And I think it'll be foolish to say with high conviction that the economy is now terminally slowing down. But if I placed a bet today, I think we are going to see a meaningful slowdown in the US economy. We're already seeing a pretty lackluster European economy. And the rest of the world, of course, will have similar features. So what we are backing in our investment approach today is a consumer that will be slow for the next 2, maybe 3 years, and backing businesses that will do well and continue growing through that kind of environment.
Okay. That perspective naturally raised a question about the regional balance. So let me ask about the US and Europe. Permira started in Europe, but today you operate across Europe and US. The US rewards speed and execution, while in Europe you build depth in more complex and regulated industries. When both regions show different opportunities and risk, how do you compare them? And what factors matter most when deciding where to allocate capital today?
Yeah, so we are practically completely transatlantic today. So if you look at our portfolio, we are about 45% deployed in North America, 45% in Europe, and 10% in the rest of the world. And our teams operate in a completely integrated way across the Atlantic, and we will pick the best risk-reward opportunities where we see them. Now, having said that, and by the way, we feel really good about that because that allows us the flexibility to explore and compare and contrast. Now, having said all that, for the first 25 or so years of my career, in fact more, I spent in different forms defending why Europe is an attractive place to deploy capital and why all the capital in the world shouldn't go to the United States. So you look at the data in controlled private equity, which is predominantly what we do. The returns in the US and Europe have been pretty much the same. You look at 5, 10, 15, 20-year time series, and some of them will show that Europe has been a bit better, some that the US has been a little bit better. But the same differential that you see in public stock markets, where US stock markets have outperformed the European stock markets, that does not exist in private equity. That's first point. And that's, by the way, because a high governance, high activity ownership model in a less efficient economy can do more. So that's why private equity has worked really well in Europe. Now, but nevertheless, we had with our investor partners, who will be sovereign wealth funds and pension funds and insurance companies and so forth, we had to convince them why putting some capital into Europe was a good idea. And today, suddenly, that's flipped around. So suddenly, we have this dynamic where a lot of our global capital allocator investors are saying, well, hold on, maybe I trusted the US a little bit too much. Maybe the dollar is on a longer term decline because of fiscal and monetary policy and some of the political changes. Maybe Europe actually is going to experience a significant both capital and entrepreneurial boom, and I want to have more exposure to that. And of course, then there's the geopolitics of that, and we'll maybe get back to that, but there's some pools of capital that are actively moving capital away from the US, and Europe is one of the obvious beneficiaries of that. So consequently, today, we are seeing an environment where, for us, capital is proactively seeking more European exposure, and we are one of the let's call it agents that can receive that capital and deploy it with entrepreneurs and opportunities on the continent. Now, that does not lead me to the conclusion of saying, therefore, we should focus everything on Europe, but that does lead us to the conclusion that we like the balance of being able to deploy and having the team to deploy in Europe and the same in North America.
Thank you. Your point about differences across regions lead to a broader debate. So are we facing a familiar cycle or a deeper shift? Many people ask whether today's environment is simply another stage in the cycle. rates may come down from today's level, but it seems unlikely we go back to the days of near zero interest. At the same time, supply chains are being reshaped and cost of energy and climate transitions are rising and productivity is being changed by AI. So do you see this part of a normal cycle or something fundamentally different?
Yeah. So I think there's a few things that are normal cycle, and there's a few things that are fundamentally different. So I think the consumer cycle, the financial market cycle, the ebbs and flows of liquidity and commitments into alternative assets, all of those things, they are normal cycles and they tend to self-correct over time. I think the big secular shift that we're experiencing now is, I think, I'm born in 1969. I'm being very, very vulnerable here. So I grew up in the sort of, my early formative years were the Cold War type of environment until I was about 20 or so. And then, of course, the Berlin Wall comes down and the Cold War's over. And we roll over into this belief system where we saw increasing global integration. I think all of us, whether you were in China or in Europe or in the United States or in Russia or in Korea, increasing global integration was one of the guarantors of economic success and also peace, ever-increasing peace. And this created enormous opportunities for all of us. Whether I think of a Korean success story, I'll use Samsung, being able to grow an incredible global business out of here, or I look at my native Finland and how Nokia came out of there and explosively grew its business into China and everywhere around the world, or any of the large US tech players. So global integration was the way to go. We, in our portfolio, we owned a number of different consumer businesses. I'll use Hugo Boss as an example. We grew into China, we grew into North America, we grew across Europe, also here in Japan. And that was a very attractive way for all of us to spend our entrepreneurial time and resources and capital and to create value. Now, the significant shift that we are seeing, of course, is a reversal of that global idealism. So, whereas we thought, and by the way, I still think that that's the best path for humanity for both peace and prosperity, the forces that we have had at work over the last, let's call it a decade or so, of course, you can trace it back a lot longer than that, or you can take a shorter perspective, but I think for the last decade or so, we've had an accelerating force of nationalism in the United States, across large European nations, in a number of Asian nations. And over time, when you let those forces operate, they will then create adversarial dynamics that initially, although they seem mostly political, they then translate into the economy through everything from tariffs to trade restrictions to sanctions. And this, it becomes this self-reinforcing dynamic of less trade, less shared outcomes, and more suspicion even. And I think this dynamic, having spent my first 30 years of my professional career going in one direction, now we are having to reinvent some of that and figure out how to operate in an environment where supply chains are being brought back onshore in the United States, where Europe has to think about regional sovereignty, where Europe has to start yet again investing in defense, aggressively so, having relied significantly both on peace and on the US security umbrella. And by the way, that dynamic, of course, is the same in many other countries around the world. And this creates opportunities, but it also creates meaningful requirement for rapid change and adjustment of mindset. Now, if I look at that, again, what it means in Europe, you've heard the number 800 billion euros as an investment commitment stated by politicians into defense capabilities. You've heard the number of 5% of the NATO spending target, 3.5% of that into hard defense, 1.5% of that into enabling infrastructure. All of those things, perhaps they will not all happen to that extent, but they directionally are setting the agenda for the next decade. And that's a lot of work, it's a lot of opportunity, and it's a very different mindset from what we've been executing on thus far. Now, for me, I think it's not an or, it's an and. So that's a sort of secular shift that we are dealing with. I think the other secular shift, and this is again going back perhaps to a dynamic that we saw in the 1970s last. So in the 1970s, we had the bond vigilante kind of dynamics where investors started losing faith in government bonds and refused to buy at the rates that were available at the time. Of course, those rates were set in a very different way then than what they were now. And then we've had a number of decades where no one's kind of really worried about whether the US Treasury is good for repaying long-term bonds. Same thing in the UK, same thing in most European countries, same thing in Japan, and so forth. And now suddenly, the financial markets are starting to ask, but wait, hold on, so is it really right to trust that the dollar is a dollar, and is that really the right place to put my capital? And I think we're only seeing the start of this dynamic. So, as you talked about this, the rate environment, I think the rate environment is merely a signal to the level of trust in sort of government-issued fiat currency, as someone in the crypto world would call it. And the way that then translates into investment behavior is at the moment we are seeing the price of gold going up, but it's really about how do you think about redeploying capital from currency and currency with yield into real assets. And I define real assets very broadly. I define real assets as, a house, but I also, or a power plant or a transmission line, but I also define real assets as a great software company that creates utility for its customers and grows every year. I define a consumer brand as a real asset. I define a pharmaceutical product company as a real asset. And of course also commodities and other kind of things that us humans want to need. So what you really want to own is scarce real assets that more and more people in the world want to own, and ideally scarce real assets that more people want to own that are growing. And that then guides how, as a global asset allocator, one would approach this secular shift where if we're not quite sure about whether US or British government bonds are going to be good in the long run, what do I want to own? Well, I definitely want to own a great company, and I probably want to own a big piece of land in a unique place, and I probably want to own a commodity that is needed by humans to thrive.
Thank you. Now let's move on to these industry sectors. So Permira has chosen to go deep in a few core sectors rather than pursuing opportunities mainly by region. What led to that choice? And how has it shaped the way you source deal and manage risk? Looking ahead, which sectors or investable themes do you believe the best place to drive sustainable growth over the next decade? Being a technology or software-only investor over the last 15 years was probably a good thing. But does that still hold in today's environment?
Yeah, so everything starts from an anchor belief, and then we can kind of derive the answer from that. So the anchor belief is back long-term dynamics and create or back winners in those long-term dynamics that will benefit from that. And for the last 15 or so years, we said that as a firm, we want to invest in situations that are reflective of that. For the last 15 years or so, enterprise software has been an enormous winner in that space. Consumer online marketplaces has been an enormous winner in that space. And therefore, sort of technology-centric investments have been one of the very core pillars of our investing activity. I don't think it's worked to be a generalist, country-specific or regional-only investor that does a bit of everything. That time in our industry was in the 1970s, the 1980s, the 1990s, where you could just have capital and entrepreneurship and you could create returns. But over the last decade or two, it's been about having a profound view on what themes are creating long-term compounding profit pools in the world, and then backing and driving with control governance these. So that's sort of the core belief that steers everything that we do. Now, I think over the next decade, what's happening is that just being a good software investor is not going to be enough. You need to be great at the application end of, okay, well, technology is interesting per se, but what does it actually do? Does it do pharmaceutical product discovery? Does it do better customer service for a consumer company? Does it do workflow efficiency for a bank or another financial institution? And then you invest in these applications and you apply technology in order to drive better outcomes more with higher productivity. So that's why when we pick our sectors, the 5 sectors that you mentioned early on, within each of those 5 sectors, what we really are looking for is investable themes that have the characteristics that we're looking for, and where we can use our capabilities and perspectives, including, but not limited to, being one of the foremost technology investors in the world, with active governance. So typically with control of the companies, where we can drive the strategy and the operations and the leadership team of the businesses for better outcomes. And that's sort of where we are putting our brain power and how we are directing the firm going forward.
Okay, thank you. And speaking of execution, let's turn to AI. So, which is changing how firms operate. So AI is attracting enormous attention, yet many organizations still struggle to turn it into real value. So you said AI isn't just a passing trend, it's a real tool that improves daily operations and drive productivity. So how is Permira actually using AI in due diligence, in portfolio work, and to create an edge? And in your portfolio companies, have you seen AI deliver clear improvement in operating performance?
So let's kind of first go through, like, what is AI and what is it not? So it is a very significant technology advance and revolution. It is akin to what I saw in my 20s, the internet doing, and then in my 30s, mobile technology doing, and in my 40s, cloud computing and cloud compute delivered software doing. What it is not, it's not an existential threat that's going to wipe humanity off the planet of Earth, and it's not a replacement at this point in time for example, all type of software that we have. We should remember today's AI is a language statistical model with some tweaks, with some guardrails, but it's designed to write well. And then you can apply the same science and the same statistical models to everything from genetics to proteins and biological compounds. And the opportunities are really limitless. And one of the areas that fascinates me most is what you can do with turbocharging pharmaceutical molecule discovery and doing so in a way which is individualized to your DNA. So I think it's many things, But I also see similar aspects to what we had in the dot-com boom, then followed by a bust. You have an enormous amount of capital investment. You have an enormous amount of belief expressed through valuations, which are based on nothing else than, well, the last round was at 35 billion, so therefore this round must obviously be at 70 billion, and then that happens again and again. Because people see the opportunity to create, possibly, the next monopoly in technology. I think it's more likely that this is going to be a pretty oligopolistic and commoditized end of the market when it comes to foundation models, but that may be wrong. The way we are approaching it is, if I look at the different layers of AI, there's the infrastructure layer, which is data centers and the power supply, the land, and so forth to those. Then there's the foundation models, that's Anthropic, OpenAI, Mistral, and of course, many, many more. And then there's the application layer of, okay, what do you do with all this stuff? How do we create value, for you and for you and for you doing this? We're investing in the infrastructure layer because that's a predictable, contractable, understandable part. So we're, for example, land banking in the US for that, and we've committed some capital for data center build. We are not investing in the foundation model layer because that is, first of all, the unit economics for us are too unpredictable. The valuations are too high, and we are not deep scientists with that expertise. So we said, let other people do that. We are investing massively, so 90% of our brain calories go to investing in the application layer. So, for example, in the customer service space, we own a couple of companies that have that sell the systems of records for everything from customer service agents to contact centers. And there, you can now start delivering better, faster outcomes with using AI than what a human customer services agent can do in some use cases. But you will still need the human for other use cases. So therefore, you can do more with the same number of people using software. So that's one real example. If you look at consumer marketplaces or classifieds, that's another example where the data, the system of record, is still needed, but how consumers discover and find that data, whether it's a real estate classifieds or a car classifieds business, is changing. The entry point to that is morphing to be more AI-driven. So for us, this is, again, a bit akin to earlier technology revolutions that we've lived through. It drives enormous productivity improvement. There's a lot of trial and error, and I think we need to be humble about that. So there are a lot of things that we and other investors and entrepreneurs are trying. So we're trying in our portfolio lots of different things. We're forcing discovery. We are launching a product, seeing if it works. If it does, we do more of it. If it doesn't, we do less of it. When we see something working in one portfolio company, we take that and we lift it, the idea, to our other portfolio companies in the same kind of general segment and others, and say, hey, we've really seen this working here. Why don't you try it? Speak to this person, speak to that person. So in a portfolio like ours, we get enormous scale effect from having a number of different companies that are in adjacencies doing it. I would compare it to something similar to, for example, the cloud compute transition, where we, at the time, 15 years ago, 10 years ago, we had a portfolio of premise-based software, often sold on a perpetual license, and we had a number of our other portfolio companies that were or had transitioned to cloud compute, and we said, do this, and this is what we see working with pricing, this is what we see working with technology, and try. So there's a lot of trial and error, but we get enormous traction in how we do that.
Thank you for your insight about AI. So stepping back from AI, to people and judgment, let me ask about decision making. In today's environment, more data doesn't always help. Often interpretation matters more. So you've been part of many high conviction investment decisions at Permira. And how do you build and sustain strong judgment in a team, especially when markets are moving fast?
So many different layers. So first of all, the type of investing that we do, to your point of markets moving fast, and to your earlier point of the signals in the market today, I think we need to create a talent base with an exceptionally long-term mindset. So today, in a world where attention spans often get shorter and shorter, what we need to have is attention spans that look for the next 5 years and then think about, well, what will the world feel like in 5 years' time for the following 5 years? And that's a hard challenge. So at its core, a private equity business or hedge fund allocator, any investment firm, it's a talent machine. That's kind of all we are. We have a culture, and we have a history, we have a set of behaviors, we have a strategy, and fundamentally, we are dependent on constantly recruiting in new great brains into the organization, and on an apprenticeship basis, raising, amongst those that we've recruited, the best and the brightest to become the next generation investors and leaders in the firm. And if you do this well, you create this perpetual motion engine that will constantly challenge itself. Because the one thing that is certain is that if you stand still strategically or investment mindset-wise, you're dead. So whatever worked for the last 10 or 20 years is not going to work for the next 10 years. So therefore, you need to have that disruptive power in the organization itself to constantly challenge itself. And I think this is something that is ingrained in the best organizations in the world, where they have the courage to just disrupt and throw away the recipe for their prior success and reinvent themselves for tomorrow. And if I go through our firm's history, we've been around for 40 years now, I've been part of 3/4 of that history, we have at least 3 times we've reinvented the firm and created something new from that foundation. But behind that reinvention is a culture that is very steady and stable. And I think that culture is dependent on a few core pillars. One of them is a very radically honest debate where you have young people that always believe that this is a paradigm shift and everything is going to change tomorrow. And then a bit more tenured people that have seen a few cycles and say, well, this is no different from this or that time when we heard that this is a paradigm shift. And then you have that sort of creative war of ideas, if you will, within the firm, but curated in a culture which is respectful and can land an actual point of view and a set of executable decisions from that. So we want our younger talent to come and say, look, everything we thought about AI or everything we thought about the consumer yesterday is wrong, and this is where it's going. And we want our people that have been around for a few decades to say, well, I disagree with that, and it's just the same as before. Sometimes the young disruptor will be right, and we have to give him or her the license to go and execute and invest to back their judgment. And so that's one core pillar of the culture. The other core pillar of the culture is that we are actually quite unusual in the private equity GP world today, because we remain a private partnership, and we are committed to remaining a private partnership. And what that means for us is that we keep on moving the ownership of the platform from generation to the next. So the best young new talent that arises through the firm has a claim in the future on both the economics and the governance and the leadership of the firm. And that means that we provide uncapped career opportunities for our best talent. But then we also run it with a pretty tough meritocratic mindset. So sort of in at the deep end of the pool, and either you succeed or you don't succeed. And those that succeed, we can back with very significant capital and growth opportunities to build their careers. And yet all of this is tied together by a global culture of collaboration. So there's sharp ideas, but no sharp elbows, if you will. So we always believe that the collective is much smarter than any individual. And I think that's the fundamental tenet of any investment organization. If we believe that any individual is smarter than the collective, then those individuals should go off and raise their own capital and invest. But we believe that with the complexity that the world is facing today, the complexity that we have in our business and the vast span of capabilities that we need to have as a firm, scale really matters. And having the talent base to cover everything from what does AI mean to a B2B services business to, how do I deal with Italian taxes and how do I raise financing for a buyout. All of those things need to come together to how do I best drive governance in a boardroom. And no one individual can do that. So we therefore invest in and let the collective drive that.
Thank you, Kurt, for the insightful conversation, and thank you, audience, for your attention. It's a great privilege to be here, and I hope you enjoy the rest of the forum. Thank you.
Thanks for having us.